Hello and welcome to my HomeBuyer Class, the nation's #1 information resource for new homebuyers. I'm Larry Harris, author of How to Avoid the 3 Biggest Mistakes Most People Make When Purchasing a Home. Buying a new home is one of the biggest financial decisions that most of us make in our lives. Yet as big as that decision is, many new homebuyers enter into the market with very little knowledge of what to expect. The purpose of this class is to equip you not only with the tools and knowledge to become an educated and informed homebuyer, but also to share information that could potentially save you thousands of dollars when purchasing your next home. So let's get started. First, we'll begin with the 3 basic economic reasons for owning a home. Reason number 1, real estate is an investment. As a matter of fact, it's one of the best investments that you can make in life. Investing in real estate allows you to 1. Use other people's money to leverage your investment, 2. Control a large asset with a small initial investment, 3. Increase the value of that asset through potential real estate appreciation, and 4. Earn a profit on the entire value of that asset, not just your investment in it. For example, let's say you're purchasing a home for $250,000. If you were putting 20% down, your investment amount would be $50,000. If you put 10% down, your investment amount would be $25,000. Let's assume your home appreciates an average of 4% per year. If you put 20% down, you will have earned a 20% return on your investment. But if you put 10% down, you will have earned a 40% return on your investment. Remember, when you use the concept of leverage, you're controlling a large asset with a small initial investment. Hence, the smaller your out-of-pocket money towards down payment, the greater return on your capital invested. Reason number 2, real estate is a tax deduction. Let's take a look next at renting versus owning your own home. In this example, we'll look at a person paying $900 per month in rent, and we're going to compare the rental payment to owning a $150,000 home. Here, the mortgage payment is $287 a month more than a rental payment of $900. Well, you might say, I can barely afford my rent. How can I afford to pay $287 more per month? Well, in order to answer this question, we must compare the rental payment with the mortgage payment after the tax benefits have been calculated. To do this, we have to answer the following questions. 1, how much of the mortgage payment PITI is tax deductible? And 2, what tax bracket is the borrower in? Let's take in this example a mortgage of $142,500 at 7%, which is equal to $9,975 in annual interest, or $831 per month. Therefore, $831 out of the total principal and interest payment of $949 is interest and is therefore tax deductible. Once we add back in the taxes of $150, we realize a total deductible portion of $981 per month. That's 83% of the total PITI payment of $1,187 per month. Now that we know the deductible portion of the payment and we've determined the tax bracket, we're able to calculate our total tax savings. Let's assume you're earning $60,000 per year or $5,000 per month. In this example, your federal taxes would be $1,312 per month. Once we deduct the $981 from our $5,000 monthly income, we've reduced the federal tax obligation down to $855 for a total tax savings of $457 per month. Now, once we deduct the $457 from the total mortgage payment of $1,187, we realize the net cost of the mortgage after the tax savings is only $730 per month. If we compare this to the rental payment of $900, we now realize that the mortgage payment that we thought was costing us $287 a month more than rent is actually saving you after taxes a total of $170 per month. Reason number 3, real estate is an inflation hedge. Inflation is the tendency for expenses to rise over time. A hedge is an instrument that provides financial protection against inflation. If your present rent is $900 per month and is increasing at an average inflation rate of 5% per year, by your 10th year, your rental payments will be $1,466 per month. That's almost a 62% increase over time. By comparison, a mortgage payment resists the pressures of inflation. Since a large portion of the mortgage payment, we'll say on average about 80% is the loan repayment, the remaining 20% for taxes and insurance will be the only portion subject to inflation. Let's compare a rental payment of $1,000 per month with a mortgage payment of $1,400 per month. If we use an inflation rate of 5% over 10 years, the rental payment would increase to $1,629 per month. However, only 20% of the mortgage payment has increased, bringing the total mortgage payment to $1,546 per month. In the rent example, the total monthly payment has increased by $629. By comparison, our mortgage payment has only risen by $146. That's almost a $500 per month difference even before factoring in our tax advantage. I guess by now you can see there are strong economic advantages to owning your own home. Let's take a look next at the different types of mortgages. There are two terms commonly used in the mortgage industry to describe the different categories of mortgage loans. These are conforming and non-conforming. Conforming loans are mortgage loans that are guaranteed or backed by the U.S. government. These include Fannie Mae, Freddie Mac, FHA, and VA loans. If you borrow conforming mortgage money from a lender and you default on the loan repayments, the government guarantees the lender to repay a portion of your loan debt. If you put less than 20% down, these programs require you to purchase what is known as private mortgage insurance, or PMI. It's important to note that once your mortgage balance falls over time to 80% or less of the increased value of your home, to contact your mortgage lender and arrange to have the PMI insurance costs drop from your monthly payment. Because these loans are backed by the U.S. government, reducing the lender's risk, these programs allow home buyers to purchase a home with minimum down payments at reduced interest rates. Conforming loans have set uniform qualifying standards. Many lenders today use a computerized automated system, otherwise known as desktop underwriting, or DU. This system allows lenders to submit your loan request through the government's automated underwriting system and quickly determine your qualifications for financing. The second category of mortgage loans are non-conforming loans. Non-conforming loans are mortgage loans that do not conform to the government lending guidelines. These are loan programs that are designed to accommodate borrowers with financing needs that cannot be met through conforming loan programs. Some of these categories include jumbo loans, subprime loans, portfolio loans, commercial loans, as well as others. One example of a non-conforming loan program would be a self-employed borrower who wants to purchase a property with no money down. This borrower may be able to easily afford to pay the mortgage, but cannot document sufficient income to qualify. Therefore, a non-conforming loan product would be required to accommodate this borrower's financing needs. When acquiring financing that's designed to accommodate special financing needs such as this, remember, with increased risk come increased rewards to the lender. Let's take a look next at the different types of loan products. There are several types of loan products available in the market today. These include fixed rates, fixed rate hybrids, temporary buy-downs, adjustable rate loans, credit lines, interest-only loans, and cash flow option loans. The first product we'll look at are fixed-rate mortgages. Fixed-rate mortgages are loans that offer set monthly payments for fixed terms for the life of the loan. These include 10-year, 15-year, 20-year, 30-year, and even 40-year terms. The next category of loan products we'll look at are called fixed-rate hybrids. Fixed-rate hybrids are loans that offer a fixed rate for a set period of time in the beginning of the loan and then convert to an adjustable rate for the balance of the loan term. Fixed-rate hybrids are offered at interest rates generally lower than standard fixed-rate programs. These include 3/1 ARMs, 5/1 ARMs, 7/1 ARMs, 10/1 ARMs, 228 ARMs, and 327 ARMs. These programs can save you a ton of money over time, especially if you know that you're only going to reside in that home for a certain period of time. For example, the typical American family resides in the same home for an average of 5 to 7 years. If you know that you plan to move within that time, why pay the extra hedge charged on a standard 30-year loan? The next product we'll look at are temporary buydowns. A temporary buydown is a fixed rate where the rate is brought down for the first few years and then remains fixed for the balance of the loan term. The purpose of a temporary buydown is to make the mortgage payments more affordable during the early years. This allows a new homebuyer to have reduced mortgage payments for the first few years while allowing their job income to grow. For example, the following chart illustrates the payments required for a 2-1 buydown, 30-year term mortgage with a start rate of 4% and a loan amount of $100,000. The payments for the first year are $477 per month. In year 2, they're $536. And in year 3, they're $599 and remain fixed at that payment for the balance of the loan term. The next product we'll look at are adjustable rate mortgages. Adjustable rate mortgages are mortgage loans that have interest rates that change over time. These adjustments can occur either monthly, semi-annual, or annually. Adjustable rate mortgages are generally offered at interest rates much lower than fixed rate programs. For example, if the 30-year fixed rates are at 6%, the start rate on adjustables may be at 3.5%. Adjustable rate mortgages are comprised of two factors, an index and a margin. An index is an economic market indicator that adjusts based on market trends. Some of the indexes used for adjustable rate mortgages include T-bills or TCM, which stands for Treasury Constant Maturity, COFI or the 11th District Cost of Funds Index, CODI or the Certificate of Deposit Index, LIBOR, London Interbank Offered Rates, CPI, which is the Consumer Price Index, and MTAs, which is the Monthly Treasury Average Index. To obtain historical data on any of these indices, visit www.mortgage-x.com. A margin is a percentage of profit charged over and above the market index. For example, if the cost of funds index is at 2% and the margin is at 2.5%, the fully indexed rate would be 4.5%. Most adjustable rate programs have annual and lifetime caps. For example, if you start off with an adjustable rate at 3.5% and the program has 2 and 6 caps, this means that the rate cannot increase or decrease by more than 2% per year or 6% over the life of the loan. The next category of mortgage programs we'll look at are credit lines. The simple definition of a credit line mortgage is a revolving account secured by real estate. Think of how you use a credit card. As you pay your balances down, your availability of use up to your credit limit increases. And as you use your credit card, you can run it up or pay it down an unlimited amount of times up to your credit limit. A mortgage credit line works exactly the same way but has other distinct advantages. One, the interest you pay on your mortgage credit line is tax deductible, the same as any other loan you obtain on real estate. Two, credit lines can be issued on real estate up to 90% and in some cases up to 100% of the market value of your home. Three, credit lines are usually offered at a margin of 1 to 2% above the prime lending rate, which is the lowest rate offered to the best bank customers. And four, real estate secured credit lines can be issued in conjunction with a first mortgage to purchase real estate. Overall, with the right discipline and proper use, a real estate secured credit line can be an excellent financial tool. The next loan program we'll look at are interest-only loans. This is personally one of my favorite loan products. An interest-only loan is a loan program that allows you to make monthly payments that are equal only to the interest amount due each month for a set number of years. After the interest-only period is up, the loan then converts to an amortizing loan until it's paid in full. For example, the monthly payments on a $200,000 loan fixed for 30 years at 6% are $1,199 per month. The monthly payments on an interest-only loan at the same rate on the same loan amount would be $1,000 per month. That's a difference of $199 per month. Well, if you're like most people, you're probably saying, why would I want a loan where there's nothing being paid to my principal? Shouldn't I pay as much to my principal as I can so I can own my home as soon as possible? Well, before writing off, no pun intended, the concept of an interest-only loan, consider these factors. 1, with an interest-only loan, you can deduct 100% of what you pay to the lender from your annual income. 2, you gain the advantage of much lower monthly payments than you would have with an amortizing loan, freeing up extra money for you to invest. And 3, you still build up equity in your home through real estate market appreciation. Remember, the average American family resides in the same home for 5 to 7 years. So why put the extra money into principal all to sell the home and get your money back with zero interest? It's also a fact that many homeowners pay off their homes all with the goal to be able to go back and borrow money from their homes again for things like college tuition and home improvements. I challenge many home buyers to select the mortgage with the smallest monthly payment that gives you the biggest tax break possible and invest the difference. Remember, let your hard-earned dollars work for you and not the bank. The last of our loan products we'll look at are cash flow option loans. Like interest-only loans, cash flow option loans are great financial strategy loan products. A cash flow option loan gives you one of 4 monthly payment options. You can pay the interest-only payment, usually when the interest-only payment exceeds the minimum payment. You can pay a minimum payment based on a very low introductory rate offered for up to 1 to 5 years. Or 3, you can pay the fully indexed 30 or 15-year payments. Cash flow option loans usually have payment caps of 7.5% per year for the first 5 years and set lifetime caps. For example, if you're paying $1,000 per month in year 1, the maximum your payment could go to in year 2 would be $1,075. This would calculate to less than a 1% interest rate adjustment per year. It's important to note that cash flow option loans are adjustable rate mortgages. If the rates go up and the interest-only portion exceeds the minimum payment option, you may defer interest on these loan products up to 110% of the original loan amount. For example, if you borrow $200,000 on the option loan program allows you to make minimum monthly payments based on an introductory rate of 1%, your payment would be $643 per month. However, if your fully indexed rate is 4%, your interest-only payment would be $667. That's a difference of $24 per month. That $24, or whatever the monthly interest-only portion that exceeds the minimum payment, would then be deferred and added back to the principal of the loan. Remember, with an option loan, you never have to defer any interest. It may, however, be an option for you to choose from. The next area we'll look at is qualifying for a mortgage. There are 4 key areas that lenders measure when qualifying you for a mortgage. They are credit, debt to income, cash reserves, and collateral. Let's examine the first area, credit. In our free report, we explain everything from how to obtain and examine your credit report with how to repair your credit. In my HomeBuyer class, we'll look at credit scores and their weight on your borrowing ability. Today, many lenders rely heavily on credit scores to determine your likeliness to repay the loan. Through credit scores, lenders determine how much they are willing to lend you in relationship to the purchase price of the home. This term is better known as loan to value. The following chart can be used as a general industry guide for determining loan to value qualifications based on certain credit scores. If you have a middle credit score of 640 or above, you can borrow up to 100% of the purchase price under many loan programs. If your credit score ranges from 620 to 639, you can borrow up to 95% of the purchase price with 5% down. You'll notice a trend on the chart that the lower your credit score, the less risk that the lender is willing to take. In other words, they will want to see you put more of your own funds into the transaction to show your commitment. Remember, this chart is a general representation of common loan-to-value ratios available through most lenders. These figures may vary slightly from lender to lender. When qualifying for a government-conforming loan, you may qualify for higher loan-to-values depending on a variety of factors. The government's automated underwriting program will determine what you qualify for. The second area that lenders measure is debt to income. Debt to income is a measurement of how much your monthly mortgage payment plus your other monthly ongoing credit bills are in relationship to your gross monthly income. These calculations are called your front and back end debt ratios. For example, if your total mortgage payment, including taxes and insurance, comes to $1,000 per month, and your combined gross monthly income comes to $4,000, you divide the $1,000 by the $4,000 for a front-end ratio of 25%. If your other monthly credit bills come to another $500 per month, then combine that with the total mortgage payment for a total of $1,500 per month. Then divide this figure by your combined gross monthly income. If you divide $1,500 by $4,000, you come up with a total back-end ratio of 37.5%. The following chart shows debt-to-income ratios allowed on government-conforming loan programs. Fannie Mae allows debt ratios of 28 and 36%, FHA allows 29 and 41, and VA allows 41 and 41%. Non-conforming loan programs offer front and back-end debt ratios up to 50% depending on the loan program you choose. If you're self-employed and your ratios are out of line with those required by the lender, you may qualify for financing through a no-income verification loan program. There are various types of no-income verification programs. These include no income with verification of assets, no income with no verification of assets, no ratio programs, and no doc loans. No income with verification of assets are often referred to as stated income with verified assets, or SIVAs. In simple form, the borrower cannot verify enough income but can verify sufficient assets according to the program requirements. The second program is called no income with no assets, or often referred to as NINA. This means that the borrower can qualify based on credit but can neither document sufficient income or assets as required by the lender. The third program we'll refer to is no ratio loan. This is a loan program where no ratios are calculated or required and no income documentation is required also. The last program is a true no-doc loan. This is a loan program where not only the income and assets are not documented, but they're also not stated on the loan application. The next area we'll look at when qualifying is called cash reserves. Cash reserves is the amount of liquid cash that you have in the bank that can be verified. Cash reserve requirements may vary depending on the type of loan program that you choose. Lenders place importance on verifying cash reserves to determine sufficient savings for down payment and closing costs, as well as additional cash needed to cover your first few mortgage payments. Conventional loans require verification of funds equal to 2 months mortgage payments in seasoned liquid cash reserves. Seasoned means simply that the money has been in your account for the last 2 months. For example, if your mortgage payment, including principal, interest, taxes, and insurance, is $1,000 per month, the lender will want proof via your last 2 months' bank statements to verify that you have a minimum of $2,000 left back in your account after your down payment and closing costs have been paid. It's also important to note that if you have made substantially large deposits recently into your account that are not consistent with your normal deposit activity, the lender will want proof of where those funds came from. You may have just received an income tax refund, a bonus from your job, or a big commission check that you just deposited into your account. If so, make a copy of that check before depositing it for documentation of where those funds came from. Other loan programs require verification of up to 6 months cash reserves depending on the program guidelines. So be sure to ask your loan officer what are the cash reserve requirements for the loan program that you've chosen. The last area that lenders measure when qualifying you for a mortgage is the collateral itself, the real estate. Remember, when purchasing a home, you're leveraging a large asset with a small amount of your own money. The majority of the funds required to buy that home are coming from the lender. Therefore, the condition and marketability of the collateral being used is very important. When measuring the collateral, most lenders require the completion, receipt, and review of a uniform residential appraisal report. Residential appraisals apply to living quarters from 1 to 4 units. Any property over 4 units is considered commercial real estate. When the lender receives the report, they look to measure the following areas. 1, the overall condition of the property. 2, the average marketing time of the property. And 3, the value of that property based on similar homes that have sold in the neighborhood within the last 6 months that are located within a 1-mile radius. It's important to note that if you're buying a fixer-upper, most conventional lenders will not make the loan if the property has more than 5 to 10% cost to cure. Cost to cure is the dollar amount of work required to complete repairs needed to the property. For example, if you're purchasing a property for $100,000 that needs $12,000 worth of work to bring it up to fair market condition, the lender will require proof that these repairs were made prior to settlement. Some lenders offer rehab loan programs that provide monies not only to buy the home, but also to fix it up as well. Now that we've completed the areas that lenders measure when qualifying you, let's take a look at some other areas of importance. Earlier in our class, we mentioned the term PMI, or private mortgage insurance. Let's talk for a minute about some ways that you can avoid paying PMI. PMI is required by all government lender programs and some non-government lender programs when you put less than 20% down. Remember, PMI insurance is insurance that guarantees the lender in the event that you default on your loan payments. In essence, this is basically a waste of your money. One way you can avoid paying PMI is to do what is known as a combo loan program. Combo loans are a combination of 2 mortgage loans, generally a first and second mortgage, used to purchase property. Combo loans include 80-10-10 plans, 80-15-5 plans, and 80-20 plans. These combination loan approaches allow you to purchase a property with as little as 0 down without purchasing PMI. Many lenders have combo loan programs but don't generally offer these products unless asked. A combo loan program allows you to combine different types of loans on one property. For example, you may combine an interest-only first mortgage with a combo second mortgage line of credit. With this combination loan approach, you not only avoid paying PMI, but you could potentially increase your tax advantage as well. Another area we'll look at are discount points. Points are a percentage of the loan amount charged by the lender in order to reduce the interest rate. Each point you pay reduces the interest rate by an average of 3/8 of 1%. For example, if the interest rate being offered by the lender is 5 7/8 with 0 points, if you pay 1 point, your rate will go down to about 5.5%. If you pay 2 points, your rate would go down to about 5 1/8%. And if you pay 3 points, your rate would drop down to about 4 7/8%. Let's take a look at some examples of the effects of paying points on a $100,000 loan at 5 7/8 fixed for 30 years. At 1 point or $1,000, you would get an interest rate of 5.5%. This will give you a monthly payment of $567 per month. or a difference of $24 less than the 0-point rate. At 2 points, or $2,000, and an interest rate of 5 1/8%, your monthly payment would come to $544, or a difference of $47 less than the 0-point rate. And at 3 points, or $3,000, and an interest rate of 4 7/8%, your monthly payment would come to $528. That's a total of $63 less than the 0-point rate. To determine whether it makes sense to pay points or not is measured by what is known as the break-even period. The break-even period is the length of time that it takes to recover your out-of-pocket money based on your monthly savings. In the last example, paying 1 point dropped the monthly payment down by $24 per month. If you take 1 point, or $1,000, and divide that by the monthly savings of $24, you get 41.67, or round it off to 42 months, which is equal to about 3.5 years. So if you plan to reside in the property for more than 3.5 years, you can calculate your savings beyond that point. For example, if you live in the property for 10 years and you pay 1 point, you multiply 10 years by 12 months for a total of 120 months, then you subtract your break-even period from your total years to get your net benefit. In this example, we subtract 42 months from 120 months to get 78 months. If we multiply 78 months by our total monthly savings of $24, we realize a total savings of $1,872 over 10 years. Obviously, the longer you live in the property, the greater your benefit of paying points becomes. One other thing you can check into is to see if the seller is willing to assist with your closing costs. Most loan programs allow the seller to assist with the buyer's closing costs up to 6% of the purchase price. If the seller is willing to assist, you may be able to cover the cost of your points without paying the money out of your pocket. This could save you thousands of dollars at settlement and over the life of the loan. The last area we'll look at is title insurance. Title insurance is insurance to protect you and the lender against third-party claims against the property. If you purchase a property and the seller has outstanding liens or judgments, they will show up in a title search and will have to be satisfied by settlement in order to give you clear title to the property. This also ensures the new lender their proper lien position against your property. Never ever buy any property without title insurance. This is an absolute no-no in the rule book of buying real estate. I had a recent client who purchased a property from a friend without title insurance that he wanted to refinance. Once his application was taken and a title search was run, we found 2 unsatisfied mortgages and 3 outstanding judgments that were open against the property. In order to complete this refinance, he would either have to agree to pay off these liens with the proceeds from his loan, or he could go through a legal process called quieting the title that could cost him thousands of dollars. So to avoid these types of headaches, never ever buy any property without title insurance. Well, by now you're probably saying this is a lot of information, and you're right, it sure is. Purchasing a new home is one of the largest financial transactions that most people make in their lives. So isn't it worth taking a little bit of time to get educated? I'm glad that you've taken the time to become an educated home buyer. I hope that through this class you've gained the knowledge and understanding to make you more confident and comfortable with your home buying decisions. I'm Larry Harris. God bless you and good luck in your new home.